Hello, I'm Marja Hoek Smit, the founder of the International Housing Finance Program at the Wharton School, University of Pennsylvania. The first part of this module showed the importance of housing finance for solving the housing problem. It discussed the main components of a housing finance system and the requirements for a housing finance system to work well. In developing economies, however, these requirements are often only in place for the top end of the market, leaving the middle and the lower income segment underserved. This section will specifically look at the constraints in accessing housing finance for the lower and middle income segment. It will also look at the innovative solutions that have been designed to overcome such constraints. So let's begin considering why expanding access to housing finance is absolutely critical to solve the housing problem. There are a number of reasons. First of all, housing finance increases households' ability to pay for housing. Second, housing finance leverages household savings and private sector funds for housing. Third, it helps to improve existing housing and sanitation with related health improvements. Fourthly, it allows formal mass housing production. Developers will only build for market segments that have access to mortgages. And fifthly, housing finance facilitates housing transactions of new and existing housing, and therefore it allows mobility in the housing stock. Increased access to housing finance for the underserved population is therefore at the very core of the solution to the housing problem. But low and middle income households face a number of constraints in accessing housing finance. First and most important are, of course, constraints posed by low and informal household income. Incomes are often low relative to the price of the house and the price of credit. Incomes are often too low to save for a down payment. Also, households are often employed in the informal sector and rely on informal incomes, which makes it difficult for lenders to make a loan to them. Second, there are constraints related to the property very often. The property may not be registered. Lenders cannot put a lien, therefore, on the property which is needed for a mortgage. Or they may the property may be in a very thin market with very few transactions. And lenders will therefore be afraid that they cannot sell the house quickly in case there is a delinquency. This is a particular concern when the property is located in underserviced areas. Third, a household's credit history may also pose constraints. Some households have no credit history or have a very low credit score, or they struggle with over indebtedness. Fourth, many low income households fear taking long term credit and are afraid that the house may be taken away from them on a whim by the lender. Finally, in many cases, there is simply no access to suitable loan products that are suitable for that particular income or employment group. Such products would include flexible mortgages or non-secured medium-term loans. Lenders, on the other hand, face specific constraints in serving the low-income and middle-income market as well. First of all, there is the perception that credit risks are high for this segment of the market. Lenders worry most of all that low and middle income borrowers may not be able to repay a long term loan. In addition, lenders must consider if they can recover the loan in the case of non-payment. Will the courts rule in favor of the lender? And how long will that legal process take? Second, the cost involved in making and servicing a smaller loan are relatively high relative to the size of the loan. These include the cost of underwriting, origination, and servicing the loan over time. Can the customer pay for these costs? Finally, lenders often face higher regulatory costs when they make loans to more risky customers. They have to hold extra capital against such mortgages, which is expensive. So lenders have to weigh whether these higher costs and risks can be absorbed in higher rates for more risky customers, which is often difficult for political reasons, or whether the additional cost of these risky and costly customers will have to be absorbed in an overall higher interest rate for mortgages, which may impact the lender's competitive standing. In part two, we will discuss what can be done to address these borrower and lender constraints to make housing finance accessible to low-income households. I will draw on lessons learned from countries that have successfully moved down market. I will talk about 6 key measures. First, offer more diverse housing loan products. Second, provide consumer education. Third, invest in ex ante measures to reduce default risk. Fourth, to support credit measures to reduce losses when defaults do occur. Fifth, to lower transaction costs, such as costs related to taxation and regulation. Six, to provide subsidies to qualifying borrowers. While these measures are helpful, they can only be successful, and we must always keep that in mind, if the housing finance system as a whole works reasonably well. And that requires a stable macroeconomy, a functioning property registration system, and competitive lending environments. And, of course, a working housing supply system. We will now unpack the details of each of these 6 ways to support access to housing finance. So let's look at the first one. It's important to have different, diverse housing loan products suitable for this type of consumer. That includes the households with irregular incomes. So products that have been successfully applied in several economies are flexible mortgages, which are mortgages that offer flexible repayment options or flexible lending periods that can be extended in case of that payments are missed. Another product is called the graduated payment mortgage, which lowered the payment amount during the first few years of the loan. This addresses the financial stress on households during the early years of payment, particularly for a fixed rate mortgage. Yet another product is a housing loan with scheduled pre-savings that are put in an escrow account in the financial institution and can be used when the customer has an emergency or cannot make a payment for other reasons. Other loan products deal with the lack of sound property collateral. For example, loans can be based on alternative collateral, such as other real estate that the customer may have, or pension savings. And lastly, non-collateralized housing loans may be used, such as medium-term microloans or scheduled sequence of smaller loans for self-construction. It would be ideal if the housing finance system would offer a mix of mortgage loans based on alternative collateral and non-secured housing finance products, as we show in this schematic overview of a housing finance system. Secondly, it's important to provide education for first-time home buyers and require that lenders disclose interest rates and loan conditions in a standardized way. This will enable the consumer to make an informed decision on their biggest lifetime financial commitment and will alleviate fears of taking on such a mortgage. Standardized definitions of mortgage rates and conditions will also stimulate fair competition between lenders. Studies have shown that consumer education helps reduce default risk and credit losses for the lender and materially protect the consumer. The outcome of education of buyers is therefore to stabilize demand through greater consumer confidence, and it rewards fair lenders. Third, it's important to support ex ante measures that are known to reduce credit risk. Most promising is the use of digital fintech innovations, as well as personalized surveys to underwrite income and expenditures and employment of the low income and informally employed segment, and to use digital platforms and fintech options to service the loan. That reduces cost as well. Another important measure is to have loan contracts signed or at least co-signed by in the name of the woman, including other relevant alternatives like having kids in school with regular health checkups, as underwriting criteria have proven to reduce credit risk as well. The example in the visual shows the minimum underwriting fundamentals used by a housing finance company in India. On the regulatory side, it is important that regulators approve non-coordinate survey-based land registration systems that are less costly and much faster to implement and can dramatically expand the pool of mortgageable properties. Zambia's central bank has approved such surveys for mortgage underwriting. Very important. Lastly, innovative technologies such as Google Earth can be used to support valuing or appraisal of unconventional housing. Fourth, it is important to support measures to reduce credit losses after defaults occur. This can be done by several measures, particularly moving to non-judicial systems of collateral enforcement, meaning that you don't have to go to court as a lender to be able to foreclose on a property. The visual shows how much time and costs are reduced in a sample of 42 countries when you do not have to go to the court system. Another frequently used mechanism to reduce credit losses is to develop public or public-private mortgage insurance or mortgage guarantees. Mortgage insurance typically covers the top of the loan, and since the risk is reduced, as shown in the visual, it should lower interest rates and reduce reserve requirements as well. Mortgage insurance allows for higher loan to value ratios also. However, it's always better to have, or it's always important to have the buyer pay a down payment, even a small down payment, so there is skin in the game by the consumer. Fifth, it's important to lower the transaction cost. specifically the taxation cost and the regulatory cost of mortgages. Housing finance is highly taxed in many countries through such taxes as stamp duty or lender tax on mortgage loans. In addition, value added tax is often slapped on to building materials as well as the sale of a house, increasing the cost of a low cost house dramatically. In India, for example, tax and transfer cost can be up to 27% of an average house value. Governments should consider lowering those taxes before subsidies are considered. Regulatory costs are another area where costs can be cut substantially. Central banks should set the reserve and provisioning requirements based on actual risk factors of housing loans in a particular segment of the market. And if mortgage insurance is part of the loan, the lower risk profile of these mortgages should be reflected in the reserve requirements. Lastly, 6, it may be necessary to provide subsidies to qualifying borrowers in some markets. Some lessons to consider when designing finance linked subsidies are that subsidies should be always a last resort after measures to reduce the cost and the risk are put in place. Different types of subsidies should be developed for different loan products, not one type of subsidy for different types of housing loans. Subsidies should be structured to be progressive with income. They should be lower for higher income groups. Governments should know the long term cost of subsidies and budget for them. For example, interest rate subsidies for the life of the loan are costly, and these costs are often not transparent. On the other hand, a down payment subsidy is most efficient and addresses the savings constraints of low income households. It can be targeted to the income level of the customer, and it is much more transparent. So, one cost of subsidies that is often overlooked, and I want to mention here, is the administrative cost of subsidy systems. They should be kept as low as possible. And if the private sector can be used to administer the subsidies, that is in most cases, a much better solution. In conclusion, mortgage lending can be extended to underserved households through concerted efforts by the public and private sector to improve instruments, laws, systems, competition, and procedures, by the use of fintech and innovative data, by supporting cooperation across different ministries, central banks, and industry representatives, and by ensuring a high level of political will and leadership. The big question that remains is who will take the lead to guide such efforts in the country. Each country's housing finance system is unique, and no shoe fits all. Reforms in each country respond to specific institutions and existing housing finance systems. Reforms will therefore always be path dependent. Thank you.